Hello and welcome to Wake Up and Smell the Mic S&P 500 review for Monday, April 24th, 2023. It's now the 22nd. We start off in the S&P 500 daily chart in DeMark, looking back to end of 2021. I'll zoom into the current area now. The S&P 500 has printed the combo and sequential buy setup 2 count. And to negate that, for end of day, Monday the 24th, there must be a close above 4154.87 for the price flip to the sell setup count 1. The S&P 500 missed its chance at qualifying this momentum up for 50%. There would have needed to have been a close above 4139.48 on Friday to get that qualified. There was a high of 4138.02, so the index itself really made a good show and a good try, but it hit a brick wall there and at the mid band of the Stark band, which is a 9 simple moving average. So price ended up right in between that 9 simple moving average mid band and the cloud conversion line, which is a 9 EMA. And I don't know how longer the conversion line can hold up as being very good support, as you can see these past 7 or 8 bars, but it has been holding. There was definitely a larger breach underneath it than there was the other day, but nonetheless closed above it. So the only levels in danger of becoming qualified for end of day Monday the 24th would be this ongoing demand line, which would need an open below this level, and for Monday it's at 4134.58, open underneath it and close underneath it for end of day Monday the 24th, and it gets qualified. And at 4134.58, it has a very good chance of opening underneath where it closed on the Friday the 21st. And that would put it underneath that demand line if price heads up and gets higher than this demand line, 4134.58 for Monday, and then subsequently closes underneath it for end of day Monday, then this level will more than likely become disqualified, break below it, and now the trend factor disqualified down 1 is below the Stark band and the channel 3 low, which are still traveling pretty close together right on top of each other. So it would need a close under trend factor down 1 to get qualified. And to the upside, the 50% disqualified exhaustion up will act as resistance somewhat, and the ongoing supply line is there, and for Monday it's at 4167.45, so close above that it gets qualified. Keep going, get above the other one, 4191.82 for Monday, and that gets qualified, so they would both become qualified. And the sequential buy countdown is sneaking up on us. It's on buy countdown 10, and to print the 13, there must be a low of that day below the close of this bar here on the 5th, so 4090.38. And that doesn't become a concern until we actually print the buy countdown 12. And I'll tell you, these upside moves for the S&P 500 are painful. So this is definitely a pain trade. Anybody in there that's working with this market, trading, investing, whatever, the least the S&P 500 could do, which would be incredibly good, would be to get a tick higher than this high on February 2nd, 4195.44. If that happens before it decides to roll over and head down, that would be okay, because then we have a higher high And technically we're already in a minor higher high, that's what I call it, by getting above this D wave, up wave B here at 4078.49, but I'd rather see it get above this for a tick higher, and then I think we could breathe a little easier. And if it doesn't, oh well, and it heads down and rolls over, as long as it stays above this low from March 13th, 3808.86, and then heads back up for another try, we'll still be on a higher low. And with D wave switched on only, you can see the higher highs and higher lows. Here's the C. The 1 was a higher high. The 2 was a higher low. The 3 was a higher high. The 4 was a higher low. The 5 was a higher high. And the C here, 3808.86 low, was a nail biter to get under this low, 3764, but it's still a comfortable margin. So that's what the higher highs and higher lows would be. That's why I say it would be good to get above this one, but this one's okay for now, as long as price doesn't go below this low here. The NYA top color chart shows the NYA to SPX ratio, basically value versus growth, going sideways. So everything is going sideways, value and growth. Same thing with the New York AD line going sideways, and the ratio adjusted McClellan breadth oscillator did dip its toe below zero at negative 3.94. And anybody that's following along knows I've been doing in-depth reviews of the S&P 500. I've kind of just been looking at every index and chart I have, looking at where we've been and where we're going, where we're at, etc. So now it was the NYA's turn, and I was just staring at it, looking at all the patterns and measure rules, etc. And I realized there were 3 patterns that I missed. One is negligible and wouldn't have mattered anyway, for I made a call anyway. And the other 2 were here. This is a head and shoulders topping pattern, and then another big W pattern here. And there's a head and shoulders topping pattern within this big W. And this is the pattern here, this head and shoulders within the big W. That was negligible because I made the call coming out of this diamond topping pattern. After this big W here, I said we're going to go down and test that 2020 October gap up, which eventually was hit right here exactly. And it's these 2 over here, this head and shoulders topping pattern and the other big W, that I missed due to just weariness somewhat. So this is the worst time to get weary after dealing with this market all the way since back here, this broadening top pattern. So I had to splash some cold water in my face, give myself a couple shakes, and we can't do that again. Let's run through this as an in-depth review. You can see this dotted red line here. That goes back to the bottom of the COVID crash 2020. That's the uptrend line. Look at the steepness of that. And then I knew when it got broken in earnest to the downside right here that that was the beginning of the end. I mean, one could have stopped right here and then just waited for it to come back, or wait for the bottom down here. But we stayed in it, and we started some trend lines. Here's one, a downtrend line here, and then the uptrend line here that eventually turned into a broadening top formation here. And then there was a head and shoulders pattern in here in light purple. I'll just trace it with this cross here. Here's the left shoulder, the head, and the right shoulder here, and the neckline in dashed blue extending out. And then we continued extending this pink line that was support here and there, and just kept going out with it. And you can see that it was actually very good support and resistance along the way. Sure, there were breaches underneath it, but it always seemed to hit that line. I zoomed in so that we can follow along a bit closer. So this head and shoulders pattern here broke out to the downside in earnest right here. Yeah, it had some dips below it, but it came back up and was still valid because at that time I had a trend line from the top of the head through the right shoulder. It's not there anymore, but you can imagine it here. So it was still valid, and it came back up and then eventually went under. And the measure rule from the top of the head down to where it broke out right here, 7.4%. Move the measure rule down here, and it just came really close down here to this big W, but it never made it down that far. That's just an observation. It eventually went back up, and then this head and shoulders pattern was negated here, and then it finally went under here, had a hit, and then we were able to form this diamond topping pattern using the broadening top pattern here, and that broke out of the diamond pattern right here, and we used the measure rule from the lowest part of the diamond pattern right here and the highest part up here, so 10.5%, and it eventually made it down there, 13,987.31, this line here. But along the way there were two big W's. So this big W here, 5.9% measure rule, brought it way up here, and it never did reach that. And then it plunged, meaning price, and then formed another big W. And that measure rule was 7.5%, and that one didn't make it all the way to the top, and that's when I probably should have noticed this topping pattern here, head and shoulders. But you can see on the plunge down for the second big W that it hit that diamond topping measure rule, 10% or so, 10.5%. And I was pounding the table pretty hard that we're going to visit this gap up from 2020, the very bottom of it, when it came out of the diamond pattern up here, and then those two big W's formed there. So I had my sight set for down here. However, if I would have noticed that head and shoulders topping pattern here in green, you can see the neckline in solid green here. And when it broke under here, the measure rule is 8% from the top of the head down to where it broke out and brought down. That brought it to the very top of the gap zone from October 2020. And it nailed that completely right here, just exactly this measure rule from that topping pattern head and shoulders. But we didn't know that at the time. And then it formed this big W here, and it broke out of that right here, 6.5% measure rule up here, and it went well beyond that and then came back down. And the rest is history, and I missed these two here. This head and shoulders topping pattern, which it broke out of, and that was a 5% measure rule, and then moved down, brought it to here. So that was just about spot on too. A lot of candle wicks pointed down, but pretty much the bodies of the candles were above this 5% measure rule. And then another big W pattern, and it broke to the upside here, and that's a 4.1 measure rule from B to C, and then moved up, and it absolutely nailed it right here. And now that leaves us right here where we're at today. And the way I treat these head and shoulders topping patterns, it met the measure rule quite nicely here, as you can see. So I would negate it, but technically it's not negated until it reaches above this solid green short line right from the top of the right shoulder over. There's another green line above it for the tops of these big W's, etc. But technically it's still valid, but since it met the measure rule, I don't consider it valid anymore. Same thing with these big W's. When they meet their measure rules like this one did, I don't consider that valid anymore either. And there are some noteworthy technicians out there that really poo-poo the NYA, and anybody that follows it, as they call it, polluted with closed-end funds, all sorts of crazy ETFs that market makers just make on the fly. They're all polluted with those kind of things, let alone all the bond ETFs, bond mutual funds, everything. Even my old Buick is probably for sale in there. And on top of all that are the regular indexes, so the S&P 500, the NASDAQ, every single stock in the universe is in there. But I'll tell you what, it made staying in the market and trading this worthwhile. And without it, I might have just had to get out here and just sit on the sidelines like all the other millions of people. So I personally find it very useful. The ratio-adjusted McClellan volume oscillator is below 0.2, negative 4.49, and the ratio-adjusted summation index of the ratio-adjusted McClellan breadth oscillator is going sideways a bit, and it did make it above positive 250, but we need more than that, that's for sure. And as much as I hate to say it, I mean, it's the truth. When the Fed fills the punch bowl back up again and does easing and rate cuts, then we'll go up and it'll start looking like these mountains back here again. Till then, we're just dead in the water somewhat. The ratio-adjusted summation index of the ratio-adjusted McClellan volume oscillator looks the same as the breadth one up here. And RSI 14 just can't heave itself back over this 65 line that I've drawn here, which is somewhat like the new normal for all of this year so far, and at least some of the back half of last year, 2022. You can see here, so I lowered the bar on that, and it didn't really even hit it, and is headed down. It's going for its 21 EMA in blue, but still above it. And it looks like a lot are headed for the exits here. The on-balance volume had a really big spike down and went under its 21 EMA signal line. Next up is this downtrend line here that it broke out of here, so it could be a whipsaw unless it can bounce off of there and head up again. And I've added another indicator that I had in another chart. I thought it would be useful here. It's the stocks only New York AD line, showing only the 19 and 39 EMA, 19 in blue, 39 in red. And again, this is the volume of advancers over decliners. Look at the 19 EMA in blue has a divergence here pointed down with the AD line down here, but the 39 could be drawn the other way with a arrow pointed up, but then it too fell off the face of the earth here, and you can see that the 19 is under the 39 and almost getting to zero. So it's similar but different than the ratio-adjusted McClellan volume oscillator up here, and it's somewhat similar to the stocks-only McClellan ratio-adjusted breadth oscillator down here, as you can see. It just adds another dimension, showing only the moving averages, 19 and 39 EMAs up here. And where the stocks only AD line is very similar to price, then we can scroll up and compare price to the stocks only volume AD line here. And you can see down here that the 19 EMA had a divergence from price here, and the 39, again, if you put the arrow there, would be flat across going sideways. And then looking at the oscillators again, you can see that the AD volume 19 EMA had a trajectory that was downwards, and the AD line, which is similar to what price looks like up there, had the trajectory upwards, so there's a divergence there. And the ratio adjusted McClellan breadth oscillator corroborated the volume AD oscillator here. So you can see the divergence in the windows over here, the side windows. So if you drew an arrow there and one down here, same thing here with the 19. But then again, the 39 of the AD volume, you could have had a upwards trajectory arrow there. So this is very interesting, and I'm still trying to wrap my head completely around it. But you can also see how the breadth thrusts at the bottom here of the AD volume 19 and the ratio adjusted McClellan breadth oscillator here. So these breadth and volume thrusts really gave the indication of which way price was going to go, but price had a downwards trajectory, and sure enough, it had a nice spike up. That was that big run we had here. You can see it better in the AD line right there. Very interesting. And the intermediate term volume oscillator is starting to roll over a bit there. It's still above its 10 simple moving average in blue. Same thing with the intermediate term breadth oscillator rolling over, still above its 10 simple moving average in blue. And it looks like I'm getting my wish, the instruments in the NYA that are above their 200 period simple moving averages going sideways between 50 and 60. So I like to see that, as this could just be the pause before the next leg up, or it could be the next leg down, but I like to see this here. It's more indication of a rest before the next thrust up. The CBOE total put call ratio charts KST shows it moving nicely below the 0 line, and that's measured by this grid over here on the left. You can see the 0 line. I now just can't see it making it down to this negative 150 line over here on the left. I just don't believe it's going to make it there, not with the VIX now at 16.7. I mean, that would mean that the KST, if it made it down here, the VIX would be under 14, or so I just don't see it. I believe we're going to look like this now, and these are the two good ones that worked in between the bad periods of the 2022 era. So you can see it went below 0 and then went back up, came back down again, went back to 0, a little bit of up and down and back and forth, and then it shot up. I think it's going to look something similar to that. Maybe not all of it, but maybe down to here, not making it all the way to this negative 150 line like this. The S&P 500 support and resistance levels big board chart shows the gray areas at the daily conversion line, ongoing demand line, and the pivot point. And price closed the aftermarket hours on Friday at 41.31. So to the downside is S1, then S2, and get below that it's in the 40-100 zone down to the 20 simple moving average and the 21 EMA. And the weekly diamond bottom extension perfect uptrend channel lower line is at 40.84, somewhere in that area too. If it gets that low, then the D wave up wave 2 will print at 40.99.40. So to the upside is R1, R2, the 50% propulsion exhaustion up, the ongoing supply line, and the weekly high channel 3. And the rack one is still pegged right around zero. It's at 0.09 positive and pointed up. The ATR2 is simmering down even further, 29.82, and pointed down right in the middle of its green zone. So volatility is almost non-existent. And the PPO extreme bumped up a little, back up to 3.02, so that gives the PPO level 4 as the next target at 4.50% above zero. Underneath there is the PPO level 5 at 3%. And the New York traditional McClellan breadth oscillator made it under zero, and it would require 274 advancers over decliners to get back to zero. Have a great day.